Hi friends, welcome to the unit number 21 theory portion of our AVM, and chapter name is credit delivery and straight through processing. So these are the topic which we are going to study: introduction, documentation, third party guarantee, charges over security, positions of security, disbursal of loan. So we will try to cover these 6 topics in this particular lecture, and the remaining 4 topics we will cover in the next lecture. So let's get started with our introduction first. So friends, ever wondered what happened after a bank decide to give out a loan? It is not just about approving the amount. There is a whole behind the scene checklist that bank must follow to keep themselves safe. Let's decode this in super simple way. First of all, we have introduction, that is disbursing the credit the right way. First, even if bank has approved the loan, it still has to make sure that all necessary documents signed by the borrower and guarantor. This is what they have to make sure, so that if something goes wrong, bank can take the legal action, right? So it has all the document or all necessary document signed by borrower and the guarantor, right? This is the first thing. Second thing is that has bank created a legal charge on the borrower asset, right? So you can think of this as an official recording that the borrower has placed something like a car, house, or business asset, right? So it need for creating charge, legal charge on the borrower asset. Has the charge been registered with the right authority? Because only then it become legally enforceable, right? So registration of the bank charge with right authority is very much necessary. Only then it becomes a it become legally enforceable. Now the next thing is, who will keep the original document or asset? That is called position of security. Who will keep the original document or asset, the borrower or the bank? So this decision matter, especially when things get complicated, that actually the original document or the asset will be kept by whom, right? And lastly, that how will the money will be given? How money will be given, that is called disbursement. Will it be credited to the borrower account or given via check? Whatever the mode, it must follow RBI rule, right? Adherence to RBI guideline is very important. Then comes documentation, which is called legal safety net. So friends, let's talk about document. They are not just paperwork, they are bank sealed in court if the borrower default. So what should bank ensure? First, the document must be properly stamped, no shortcut should be there. Then the next thing is, the date of signing must be after the date of stamping, and both date and place must be clearly mentioned. So this is called execution date should be after the stamping date. So signing date must be after the date of stamping with date and place clearly mentioned. Then one more thing is that if the loan is backed by a primary asset, the charge must be clearly mentioned and signed also. Suppose if a loan is given, suppose a house loan is given, home loan is given, right? And it is backed by a primary asset, like a house in this case is itself a primary asset. So if the loan is backed by a primary asset, that charge must be clearly mentioned and signed. Then the next point we have, if there is a collateral security. What is collateral security? It means something extra given as backup. So if there is a collateral security and it is owned by someone else, say a relative, then that person must first become a guarantor and then create the charge, right? So that is called for collateral security. The owner, if different from the borrower, must first become a guarantor and then create the charge. So that is the point. If there is a collateral security, which means something extra given as backup, and it is owned by someone else, say a relative, suppose it is owned by a relative, so that person must first become a guarantor and then create the charge. And lastly, depending on the type of loan, the bank's legal team will either provide a standard format or draft custom document, right? So that is called legal department prescribe or draft document based on loan type. So depending on the types of loan, the bank legal team will either provide a standard format or draft custom document. So in simple word, before a single rupee is disbursed, the bank ties up all legal loose ends to make sure that if things goes wrong, they are ready to recover the money. And that is how a smart secure lending happens in banking. The kind of insight that you need to have, right? So this for clearing the CIIB with confidence. So now you can appreciate the importance of documentation, right? And this question is most frequently asked, that what should be done first, whether execution or whether stamping. So remember, execution is done after the stamping, right, with date and place clearly mentioned. And so these things you must know: primary asset, secondary collateral security, what things which must keep in mind. Then we have key points for document execution, very important. Friends, we already know that proper documentation protect the bank like a legal insurance policy. But now let's talk about how these documents should be executed and why third-party guarantee sometimes comes into play. So the first point is, documentation execution. That is the key rule that bank must follow. So when someone sign the loan document, the bank must make sure that the person actually has the authority to sign, especially in the case of partnership or company. For example, a partner should sign on the behalf of the firm, not just as individual, and the person should sign willingly. Now friends, if we talk about the document execution, let's break it down in the simple term. When someone signs the loan document, the bank must ensure that that person actually has the authority to sign, especially in the case of partnership or company. For example, a partner should sign on the behalf of the firm, not just as individual. Then the person should sign willingly, which means no pressure, no force, and all blank in the document should be properly filled before signing, because an incomplete document can cause major legal issue later. Now comes the legal registration part, right? So legal registration part means, it means what, that if it is company, the charge or the loan security, right, must be either you call it charge or you call it loan security. If it is company, the charge or loan security must be registered with the ROC, that is registrar of the company, within 30 days. So this is a very important condition especially for company, that if it is company, then the charge or the loan security must be registered with the ROC within 30 days. Some document also need to be registered with the sub registrar office within the given time limits. And now one important thing is that charge on security and mortgage, so those must be registered with SARFAESI as per the section 26D of the SARFAESI Act. So on securities and mortgage, charges should be registered with the SARFAESI as per the section 26D of the SARFAESI Act. Now, and here is an interesting bit: if the security is something special like aircraft, like a ship, you also need to register the charge with the bodies like DGCA. So for the DGCA aircraft, DGCA, and for ship, mercantile marine department. All this ensure that the bank right over the asset is officially recognized and cannot be challenged later, right? So this must be kept in mind. DGCA for aircraft, and for mercantile marine department for ship. Now then we have third party guarantee, which is a safety net for the bank. So what if the borrower does not pay back the loan? What if the borrower does not pay back the loan? So bank often asks for a third party guarantee, someone else who promised to pay if the borrower does not. But here is the twist. The twist is that if the borrower is a sole proprietor or a partner in a firm, their personal assets are already at risk. So bank usually don't need an extra guarantee from them, right? So bank often asks for a third party guarantee, someone else who promised to pay if the borrower does not. But if the borrower is a sole proprietor or a partner in a firm, right, then what happened, their personal asset already at risk, so bank usually don't need extra guarantee from them. But if the borrower is suppose company or trust, as you can see written, so suppose a borrower is company or borrower is a trust, the promoters or the director. So this is the point. So in the case of company and other legal entity like trust, the promoter or director are not automatically liable. That is why bank may ask them to give a personal guarantee, so they also become personally responsible for the company loan. RBI also suggests that personal guarantee should be taken especially when the company is owned by a small group or related individual, not big professional or government owned company, right? So if the borrower is a company or a trust, the promoter or director are not automatically liable. That is why bank may ask them to give a personal guarantee, so they also become personally responsible for the company loan. And RBI suggests that personal guarantee should be taken especially when company is owned by a small group or related individual, means who are related individual, not big professional or government owned company. So in short, bank are not just lending on trust, they are building a legal safety web around the loan using document, signature, guarantee. That is what make credit disbursement safe and sound. If you are loving how we simplify CIB topics, smash that like button, share with your banker buddies, and don't forget to subscribe. Now friends, let's look at the next part, that is exception. Yes, exception. What are the exceptions here? Let's look at it. Friends, we have just saw how bank use third party guarantee to protect themselves when borrower don't repay. In some case it is required, in some case it is not required. Which cases I told you, right? For sole proprietorship and partnership it is not required, because their own property is at stake, their own asset is at stake. But in the case of company or related party transaction it is required. So but now let's explore some unique situation and some smart exception that every CIB aspirant must understand. There is something called special company cases. So, special company case when rule bend a bit. So, let's say the court or the law put someone in charge of a company and that person was not elected by a shareholder. In such case, the usual rule of taking a director or promoter guarantee might not apply. So, when I told you now, whenever a court or law put someone in charge of the company and that person was not elected by the shareholder, in such case the usual rule of taking a director or promoter guarantee might not apply. Like, well, usually what bank used to do, that bank used to take a director or promoter guarantee also in the case of company. But suppose the court or law appointed someone as in charge of the company, not someone elected by the shareholder, in that case bank cannot take that director or promoter as guarantor. But what if the bank still feel the need for a personal guarantee? Then in that case, then it is smarter to take the guarantee from the real owner, right? Then it is smarter to take the guarantee from the real owner, right? The key member or the major shareholders, not just a director or manager working there, right? So that is the point. Right. So because someone who hold real power and share will have a more skin in the game. So that is why it is smart move to take guarantee from the real owner, which means the key member or major shareholder, not just a director or manager working there. But wait, what if the company is even closely held? So good question. Even in that case also free. What happen if the company is not closely held? Even in that case also bank might still ask for director guarantee, and here is why. Suppose a bank gives a loan thinking, hey, this company has a great management, but later someone else take over the company. Now the bank is worried, what if the new guy mess the thing up? So by taking personal guarantee from the current key people, bank try to ensure management continuity and protect their money even if the control shift. I hope it is clear now. Right. So again I am repeating that what if the company is not even closely held? So even in that case bank might still ask for director guarantee. And why? Because bank give a loan thinking that yes, this company has great management, but later someone else take over the company. Right, but later what happens, someone else take over the company. Now the bank is worried, what if the new guy mess the thing up? So by taking personal guarantee from key people, bank try to ensure management continuity and protect their money even if control shift. So let's quickly brush up the golden rule bank follow while executing loan document. First of all, the person signing must have the authority to do so. A partner sign for the firm, not as an individual. No force signature must be freely given. Friends, all the blank must be filled before signing. Never leave empty space. And if a company is involved, the charge must be registered with the ROC within 30 days. Document must be registered with the sub-registrar in the given time frame. All charge, all mortgage must go to SARFAESI as per the section 26D of the SARFAESI Act. And for unique asset like aircraft or ship, registered with authority like DGC or Marine Department. So whether it is about knowing who should give a guarantee or ensuring the paperwork is legally rock solid, these are details that set a banker apart from the crowd. I hope that is clear now. So third party guarantee already we have discussed. So some more points is there. I think this is a repetition. Okay. Okay, fine. So this thing I have already told you. Again I am repeating the same, that what if the borrower is a sole proprietor or partnership firm? So no need for a separate guarantee here, because in such case the owner and the business are the same. They already have unlimited liability. So if they default, the bank can go after their personal property also. So no extra paperwork is required for sole proprietorship or partnership. But if it is a company, then things change. Company is treated as a separate legal entity. So even if director or promoter are running it, they are not personally liable by default. That is why bank often asks for their personal guarantee. And now let's dig deeper into why and when and why personal guarantee are taken. So if the company is closely held, right? Suppose the company is closely held, meaning a few people must hold most of the share, then personal guarantee of those key shareholder give bank extra confidence. And for company where management is appointed by a court or authority, the rule may change. Bank may not need a personal guarantee. Bank also asks company to sign an undertaking that they won't change management without bank approval, especially in the early stage. Right, they undertaking that the bank take from the management that they won't change the management without bank approval. Right. And furthermore, besides this, for public limited company getting unsecured loan, the personal guarantee from director can act like a safety net. So suppose a public limited company, right, is taking unsecured loan. So personal guarantee from director, it can act like a safety net. And suppose if the financial condition is not great, or if the parent company is more stable, the bank may ask the parent to guarantee the loan. Suppose the company financial condition is not great, right? Or if the parent company is more stable, the bank may ask the parent to guarantee the loan. And personal guarantee is also useful when there is interlocking of fund, right? So what is called interlocking of fund? Whenever there is interlocking of fund, like when multiple business are connected financially, so in that case, personal guarantee are also useful. So personal guarantee are useful when there is interlocking of fund, like when multiple business are connected financially. And finally, in the period between the loan disbursement and creating a legal charge on the asset, a personal guarantee keeps the bank protected. One last thing, no thank you money. Yes, you heard that right. Guarantor can't be paid any commission or fee for a standing guarantee unless the bank give written permission. So to wrap it up, right, so that is what, no consideration should be paid to guarantor without the bank permission. So basically, to wrap it up, the third party guarantee are not just about trust, they are about strategically securing the bank money, right? I hope that is clear now. Now let's look at some important points on charges over security. So this is very, very important. So we are decoding a crucial part of lending, how a bank secure that their loan using the asset through something called a charge, and who hold the possession of those assets. Let's break it down. First of all, charge over security. When a bank give a loan, it wants some kind of security, just in case the borrower does not pay back. But how do we make sure that make that security legally enforceable? So how do we make that security legally enforceable? That is where a charge comes in. It's like putting a legal stamp on the asset saying this belong to the borrower, but if they default, the bank has the right to claim it. That is called a charge creation. Now a few key things to remember. The type of charge depends on the kinds of the asset. The type of charge depends on the kind of the asset. Like it may be, property, stock, receivable, right? The type of charge depends on the kind of asset like property, stock, receivable, and how easy it is to manage. So whether it is the main asset securing the loan, that is called primary security, or extra backup, that is called collateral, the procedure to create this charge is pretty much the same, right? So whether for main asset or extra backup, which is called collateral, the procedure to create the charge is same. And most importantly, only the owner of an asset can create a charge on it. You can't give someone else car as security for your loan, right? You can't give someone else car as security for your loan, right? So that is called owner of the asset can only create a charge on it. This is the very important point. There are 5 main types of charge bank can create. Mortgage, so it is used for immovable property like land and building. Hypothecation, so it is used for movable goods like stock in trade where borrower keep possession. Pledge is bank take possession of the movable goods like gold or shares. Lien, bank keep custody of an asset till dues are paid like FD, fixed deposit. Then assignment means right to receive money is transferred to the bank, so like a life insurance policy or receivables. So these are different kinds of charge. Mortgage, in the case of receivable also, receivables, trade receivable we have already talked about. Assignment is created. Lien is created in the case of fixed deposit, and pledge is created in the case of gold and shares. So these are the different kinds of charge we have. Now we have possession of security. Let's talk about who holds the asset, the bank or the borrower. Why does this matter? Because who is holding the security affect how much risk the bank is actually taking. So the first thing is inventory or goods in stock. Should the bank keep them or let the borrower keep them? In olden time, bank used the lock and key method. What is the lock and key method? They give loan against goods stored in the godown, that is called warehouse, and guess what? The bank literally kept the key. But with changing time, that method faded out. So earlier they used lock and key advance. Bank used, what they used to do, that they give loan against goods stored in the godown. Suppose godown is there, goods is stored there, so bank used to give loan against those goods, and the keys were kept with the bank, right? So with changing time, this method faded out. Hypothecation has become more common. Here the borrower keep the stock but promise not to misuse it. This is more flexible and convenient, especially for working capital loan. Hypothecation, right? So borrower keep the stock but promise not to misuse it. In the case of pledge, sometimes the good stays with the borrower, but legally it is like a bank in control. Then this is called constructive possession. The borrower is just holding on its behalf of bank like an agent. That is called constructive possession. So to summarize, charge create a legal right over the asset. Possession affect the bank control and the risk involved. And as a future CIB banker, you must know which charge suit which situation and who hold what, right? So that is for this particular slide. Now friends, let's look at dispersal of loan. Very, very important topic. This is the very important topic. So how working capital loans are given and managed by the bank? So let's break it down this bite size, easy to understand pieces. So first of all, you must know what is the meaning of working capital loan, right? It is like giving an business oxygen to breathe every day. Suppose you are giving a business oxygen to breathe every day. That is called, working capital loan. So what you are giving fund to manage day-to-day expense, like, buying raw material, paying salary, or stocking up inventory. So business is being provided fund to manage day-to-day expense, and the most common way to do it is called cash credit, CC account. This is the most common way, like, cash credit account, working capital disbursement. Now what is cash credit account? See, think of it like a special type of current account, but with a twist, that the borrower can withdraw money up to a limit approved by the bank. So bank approve a limit up to which the borrower can withdraw money whenever they need, but there is a catch, that borrower must route all their business transactions through this account. That is a very important thing, routing all financial transactions through this account. And if the borrower needs to open, so no sneaky side accounts, so some side accounts should not be there. If the borrower needs to open another account in any other bank, so they need permission from the CC providing bank, and even if that is allowed, the bank will keep an eye on it, asking for regular statement to monitor what is happening. Why? To make sure that there is no diversion of fund or suspicious activity. So that is one thing, important thing. So CC account is just like your current account, and with a twist, that that the borrower can withdraw money up to a limit approved by the bank whenever they need, and the borrower must route all their business transactions through this CC account. And if the borrower need to open another account in another bank, then borrower must need permission from this particular CC providing bank, and even if that is allowed, the bank will keep an eye on it. Right. Now what is the meaning of drawing power? Because most of the time you will hear this word drawing power or DP. Since what we call it DP. See, drawing power, this is the actual amount the borrower can use from the CC account. What is the actual amount that borrower can use from the CC account is called drawing power. It is not always the full sanction limit. It depends on the value of the current asset, like a stock receivable minus current liability, like unpaid bill to supplier. So that is how we calculate. What we do, we first write the value of current asset, then we subtract the value of current liability. So current asset minus current liability, right? So but since detailed balance sheet comes in only after finalizing account, so bank asked for monthly statement, right? What bank asked for? Monthly statement of stock, and inventory, book debt, which money the customer owes, sundry creditor, money the business owes other, right? So then they apply a margin, which is called safety buffer, and calculate how much be allowed as DP. And one numerical question based on DP is asked. So I have a separate video explaining the DP, and I will share the same in the course, right? So please go through that video also, that help you calculate the DP, drawing power. What are the things that we need to take into consideration while calculating drawing power have been mentioned in that. So basically, so we can say that bank asks for monthly statement of inventory, book debt, sundry creditor, and then they apply a margin. So after applying the margin, they can calculate how much can be allowed as DP. But here is the issue. So given full freedom through a CC account sound great for the borrower, but for the bank it is like riding a roller coaster, right? So the borrower might use the full limit today and none tomorrow, or worse, use the money for things they were not supposed to. So what is the solution? So basically the solution is that we have to split the working capital limit into two parts, right? So we have to split the working capital loan into two parts, the loan component and cash credit component. So loan component is a fixed part disbursed as term loan, and cash credit component is a flexible part which is used as so flexible part used as needed. So basically the problem is that I told you a few problem, like CC account, the borrower is getting full freedom, but bank for bank it is like riding a roller coaster. The borrower might use the full limit today and none tomorrow. First reason can be, or second situation can be like this, right? Borrower use the money for things they were not supposed to. So the solution is that you have to split the working capital limit into two parts, loan component and CC component. Loan component is a fixed part disbursed as term loan, and CC component is a flexible part used as needed. So this helps the bank manage fund better and give more stability to the arrangement. Now here is what the RBI say for big borrower. So here is the key point. So for borrower, working capital is 150 crore or more, 60% should be the fixed loan component, right? So I told you, there should be two component of it. Loan component is a fixed part disbursed as term loan, and cash credit is a flexible part used as needed, right? So this help in better fund management and give more stability to the arrangement. So if the working capital limit is 150 crore or more, in that case 60% of the loan component should be 60% of that should be the loan component, right? So this help control cash flow and track fund usage. So whenever I say loan component, you must keep in mind that it is about term loan. 60% of that should be term loan. A few more RBI guidelines to remember is that export credit and inland bill limits are not the part of the 60%, right? So export credit limit and bill limits, they are not part of the 60%. And commercial paper investment by the bank quote. So commercial paper investment by the bank count as loan component. So which things count as loan component? So suppose investment in commercial paper. And the loan tenure or the loan time period must be at least 7 days, right? So the loan component tenure must be at least what, 7 days, right? And repayment can be done in installment or as one bullet payment. So as per RBI guideline, so remember, export credit and inland bill limit are not part of the 60%, and commercial paper investment by bank count as loan component. The loan tenure must be at least 7 days. So and one more thing, under multiple banking arrangement or consortium, all bank must follow these rules collectively and individually. Lastly, one more thing is that undrawn portion, right? So what is the meaning of undrawn portion? So undrawn or unused portion of the cash credit limit also have a cost. As per RBI, for large borrower, bank apply a 20% credit conversion factor on the unused portion. Why? To reflect that there is still some risk even if the borrower has not used the fund yet. So on the undrawn portion, there is a 20% credit conversion factor which is applied, right? And that is your simplified guide to disbursal of working capital loan. So whether it is calculating drawing power, understanding the DP system, or handling RBI norm, you now have the concept crystal clear. Now friends, let's look at the term loan, right? Term loan we have already covered in the previous chapter. So basically, imagine a business buying a machine or someone buying a ready to move in house. So the loan amount is not released in bits, right? It is given all at once in a single shot. But before the bank give it a portion, the borrower must first bring in their own share, that is called margin. Simple logic. Bank want to see that you are serious, you invest your share, and then the bank also add it there, right? So how does it work? Let's see. So the borrower deposit their margin with the bank. So borrower deposit with their margin with the bank. The bank debits the full loan amount in the loan account. The seller, whether it is machine company or home builder, get the payment directly from the bank. And if the borrower already paid something to the seller before taking the loan, no worry, they just need to give proof like a bank statement, and that amount count as a part of their margin, right? So that is the point. If the amount has already been paid to the seller, so they just have to give their bank statement and it count like a margin. That now what about the personal loan or loan for spending or consumption? So in that case, what happen, these are different. The loan amount may just be credited directly into the borrower account. No seller, no machinery, no construction, just fund for the borrower to use, right? So what about the personal loan or loan for spending? So these are different. The loan amount may just be credited directly into the borrower account. No seller is required, no machinery is required, no construction is required for personal loan, right? And it directly credited into the borrower account. And for big project, right, like building or plant, what happened? So in that case, the money is not released at once. Suppose the big project is there, like buildings is there, plants is there. For big projects, money is not released at once. It is given in part based on the progress of the project. Bank won't release the next chunk until they see the last part was used properly. So this is called a step-by-step funding, right, or step-by-step process. Now here is what the RBI say about the project loan. So promoters, means the person behind the project, must bring in their entire contribution upfront before the bank gives out its part. Why? Because so that promoter shows real commitment before using public fund, that is the bank money, right? So as per the RBI guidelines says that the promoters, that is the people behind the project, they must bring their entire contribution upfront before the bank gives out its part. Right. Now friends, let's talk about the debt equity ratio. So RBI want, what is debt equity ratio? Imagine a company building a factory. The total cost of the company is 100 crore. The bank gives 70 crore, which is the debt, and promoter puts in 30 crore, which is the equity. So what is DER? 70 is to 30, which is 7 is to 3, or 2.33 is to 1. So RBI want bank to be cautious here. They want to keep DRR within safe limit to avoid funding risk. So here is what bank do to manage this. First of all, promoters should ideally bring 40 to 50% of their equity upfront. First thing, promoter bring 40 to 50% of their equity upfront, and proportional equity should come in stages alongside the bank disbursement. Proportional equity funding, that is proportional equity, should come in stages along with the bank disbursement. Bank makes sure that DER stays within approved limit at all the time and never allow bank money to be used to meet equity contribution. In short, promoters should not use the bank money to show fake commitment. Now let's talk about consortium lending versus multiple banking account. So consortium lending is for big borrower, where a single bank can't handle the full loan. So multiple banks come together, form a team, and share the loan burden. So one bank take the lead, which is called the lead bank, and coordinate everything. So multiple banking is different. What is multiple banking? So there is no formal arrangement between the bank. The borrower take the loan from different bank, and bank may or may not know each other term, though ideally they share information for mutual interest. So to summarize, term loan may be disbursed in full or in stages. Promoter must bring in their share of the money and prove it. RBI want DER to stay in control, and for large loan, bank either team up, consortium, or lend separately. That is called multiple banking. So that is all of the first part, and in the next part we will continue our discussion regarding the next. Thank you.